In this video we are going to talk about 10 dividend stocks to buy right now. So before starting, please like this video and subscribe to this channel for our future updates. When purchasing dividend investments nowadays, don't only go for the highest return possible. It is vital to make a decision based on current income, as well as future growth prospects. Investing in these 10 dividend stocks to buy right now can help you build a successful income portfolio. Number 10. Grupo Aval. Colombia's Grupo Aval belongs to the international banking sector. The holding company owns stakes in 4 of Colombia's most well-known banks, as well as a Central American banking franchise and other Colombian companies active in infrastructure and concession assets, including toll highways. Crude oil accounts for over half of Colombia's export revenue. As a result, recent years have seen the economy struggle. Colombia, on the other hand, has roared back from the pandemic as oil prices have skyrocketed and the travel and tourism industry has surpassed 2019 levels of activity. Despite this, Aval is still down approximately 30% from pre-pandemic levels, owing to the fact that foreigners haven't realized that Colombia is on the rise again. Despite the company's recent announcement of record quarterly profits, this is the case. Aval pays a monthly dividend of about 2.5 cents per share, or 30 cents per year, for a 5.5% dividend yield. Number 9. Westpac Banking Corp, WBK. When it comes to overseas banks, Westpac seems promising. The corporation is a behemoth in the Australian banking industry. In recent months, the stock has dropped from $20 to $15. This is due in part to China's economic weakness affecting the prices of major Australian commodity exports like iron ore. Inflation and global growth have a huge impact on Australia's economy. Investors have begun to downplay inflation in recent quarters, instead focusing on rising interest rates and a slowing economy. If inflation becomes a major problem again and commodity prices begin to rise again, Westpac and other Australian banks should be able to recoup their recent losses. Meanwhile, Australian banks are known for paying out large dividends. WBK shares have a dividend yield of 6.2%. Number 8. New York Community Bancorp Inc. NYCB. New York Community Bancorp is a safe and higher-yielding bank for investors. The company is a specialist regional bank that specializes in multifamily financing in the New York City metro area. Even during economic downturns, the bank offers loans with a low loan-to-value ratio, guaranteeing that it suffers few losses. During the 2008 to 2009 financial crisis, for example, New York Community Bancorp remained profitable and paid its dividend. In 2021, the bank's stock rose as New York City recovered from its pandemic-induced depression. However, a prospective merger with Flagstar Bancorp Inc. (FBC) was delayed, causing the shares to fall from $14 to $12.50. Because the bank pays a 5.6% dividend yield, this is a better entry point for income investors. Number 7. JP Morgan Chase & Company, JPM. It may appear that purchasing the next stock on the list of the best dividend stocks to buy in 2022 is too late. After all, JP Morgan stock has risen by about 25% in 2021 and is trading at all-time highs. However, don't underestimate how much the core business of the country's largest bank has expanded in the same time period. Banks like JP Morgan are thriving thanks to a burgeoning property market, rising stock market activity, and an improving interest rate environment. Both the retail bank and the investment bank are performing admirably. Even after its large increase, JP Morgan is still trading at just 10 times current year earnings. The fact that JP Morgan is led by banking legend Jamie Dimon only adds to its attraction. The stock also has a dividend yield of 2.5%. Number 6. Raytheon Technologies Corp, RTX. Another major defense contractor is Raytheon. Raytheon was founded through a merger with United Technologies in its current form. This corporation then split off a number of companies, including elevators and air conditioning. Raytheon is now solely focused on aircraft, drones, satellites, and cybersecurity. Raytheon's stock price has fallen substantially behind that of the S&P 500 as a whole, owing to the defense industry's slump. It's worth mentioning that Raytheon also has a significant presence in the commercial aviation and space industries, so it's far from a pure defense contractor. The stock is currently priced at 17 times earnings, with analysts forecasting double-digit earnings growth in the future. Furthermore, the RTX stocks yield 2.4%. Number 5. Lockheed Martin Corp., LMT. The military sector had a bad year in 2021. Investors sold off the sector as a result of the Biden administration's decision to leave Afghanistan. Despite this, Lockheed Martin continues to win new contracts from the U.S. government and international governments, cementing its position as one of the top dividend stocks to buy in 2022. Finland recently awarded Lockheed Martin a $9.4 billion contract for 64 F-35 combat fighters. However, the stock market is still in a downward spiral. Many institutional investors are no longer willing to buy companies that manufacture arms, according to the environmental, social, and governance movement. Because institutions are avoiding military contractors, ordinary investors have a lower entry point. Lockheed Martin pays a 3.2% dividend yield and trades for less than 13 times projected earnings. Number 4. Intel Corp., INTC. No one thinks of technology companies as dividend payers. Exceptions exist, especially with more developed tech firms. Intel's big and reliable semiconductor business for personal computers and data centers is a cash cow. While these aren't large growth areas, they are stable and have benefited from pandemic demand. Meanwhile, Intel has used its massive earnings to expand into new, more futuristic industries. One of these, Mobileye, is a significant catalyst for 2022. Intel will spin out the company as a public company, but will retain a majority interest. Analysts estimate Mobileye's standalone value at $50 billion or more, a substantial return on Intel's $15.3 billion purchase price 4 years ago. Intel's capital expenditures will be reduced, releasing funds to reinvest in the core business or return to shareholders. Today, Intel pays a 2.7% yield. Number 3. Toyota Motor Corp., TM. In recent years, most car stock traders have focused on EV businesses. That's understandable given the flurry of activity and new product introductions in the EV industry. Traditional automakers aren't out. Existing customers, dealers, and global supply chains and logistical footprints are vast. And some have superior EV capabilities. Like Toyota's Prius, one of the first truly successful hybrid vehicles. Last year, Toyota said it would release 15 electric vehicles by 2025. It will also invest over $3 billion in U.S. battery manufacturing. Don't be fooled, Toyota is a significant player in the next generation. The company's stock trades at just 10 times its earnings. The stock also yields 2.5%. Number 2. Enbridge Inc., ENB. Oil and gas producers aren't the only ones reaping dividends from the energy sector. Midstream firms are in charge of the storage, transportation, and distribution of crude oil, natural gas, and refined goods. Enbridge may not be a household name in the United States, but it is a blue-chip stock in Canada, and the MSCI Canada ETF's fourth largest position, EWC. Enbridge owns one of North America's largest pipeline networks, and has paid consistent dividends to stockholders for decades. During the recent COVID-19 downturn, the company didn't decrease its dividend, in fact, it has increased it dramatically in recent years. While oil and gas prices fluctuate, pipelines are rather steady. Enbridge pays a 7.2% dividend yield to its shareholders. Number 1. ExxonMobil Corp., ticker, XOM. The main oil and gas firms have had a difficult 7 years. Since the oil price collapsed in 2014, most energy corporations have had to decrease their payouts in order to stay afloat. The only exception was ExxonMobil. Despite a short-term drop in profits, management maintained its hefty payout. ExxonMobil continued to invest substantially in new oil, gas, and refining projects as well. Exxon's offshore Guyana oil field, in particular, has become one of the industry's most important new energy assets. ExxonMobil is well positioned to benefit from the current rise in oil prices since it invested throughout the business cycle while most of its competitors cut back. ExxonMobil's income appeal, on the other hand, is as strong as ever. The dividend is guaranteed, even if oil prices fall below zero in 2020, and the stock yields a healthy 5.7%. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.